Hey everyone, I hope you're having a great day. It's a beautiful day here in Frederick County, almost Labor Day, and the weather gave like a sneak preview of what it's going to be like in the fall, my favorite season of the year for sure. So I want to talk today about rent payments versus mortgage payments. I had a discussion with a client the other day and he was super frustrated because he wants to buy a house, he's currently renting. And he's like, well, if I can afford to pay $1,200 a month in rent, why can't I qualify for a mortgage that's only going to be $1,000 a month? And I can understand the frustration because you feel like you fit that into your budget for the last few years, and now you want to have the same amount of mortgage. But there's some reasons why the banks won't necessarily see things the same way as a landlord might see them. So real quickly, three reasons why the landlord might give you more credit, so to speak, than a mortgage lender. One is the amount of risk involved. The landlord still owns the property whether you live there or not. So there's not a lot. The only thing that the landlord might lose out on would be potential income if for some reason you were late or didn't pay. So a mortgage lender, on the other hand, if you don't make a mortgage payment, now this lender is holding the title to your property, but they don't want to own property. They want to transact the money. They want to transact the dollars. That's what banks are in the business of doing. So the risk for them is a lot higher because now they're holding a property that they didn't want, and it's a lot harder for them to turn that into back into cash, which is what they prefer to deal with. By the way, I'm not a mortgage lender. I'm a real estate agent, so I know a little bit about this process. But if you need to find out in-depth questions about your particular financial situation and whether you qualify for a mortgage or not, you need to talk to a proper mortgage lender. These are just the broad strokes to help you through the process, okay? The second element is investment. If you're renting, the investment that you make, and so to speak, is going to be just the security deposit. And the security deposit might be maybe 1 or 2 months rent. That's not a huge amount of money compared to the value of the property. And that's why you get to live there, but you don't get to own it. When it comes time to take a mortgage out, if you're buying a property, they ask you, reasonably so, I think, to put down a percentage of the value of the house, typically 3.5% to 20% based on the type of loan that you're using. The more that you put down, the better type of loan that you can get. So it's in your best interest to have that money saved up to put down a better amount and get a lower interest rate, let's say, or just better terms on the loan in general. So again, how much you've invested determines what you get back. You invest a little bit, you just get to live there. You invest a lot, you get to own it. Make sense? All right, and then the final area that impacts that is the credit score. Your credit score, most landlords do I said do. Most landlords will perform a credit check and they will look for a particular credit score. Obviously, mortgage lenders do the same, but they have higher requirements. So if your credit score qualified you for a lease, a rental, it might not necessarily, that same exact number might not be high enough to qualify you for a mortgage. So you need to check that out, start building that credit up. There's definitely ways to do that. And a mortgage broker can help you understand how to raise your credit score. You can always work with credit repair agencies as well if you've had some real struggles with that. Okay? I hope that makes sense. I hope it helps. It is a big transition. It is so worth it. So work with a lender, find out what you need to do to qualify for a mortgage, and then find that house. Call me. I'll help you.